Most people believe the money in their bank account belongs to them. They assume it is protected, accessible, and fundamentally safe. What few understand is that, under modern banking law, a deposit is not ownership. It is a claim. The moment money enters the banking system, it becomes part of the bank's balance sheet, subject to rules most depositors have never read. This is not a theoretical risk or a distant possibility. The legal framework already exists. It has been tested before, quietly, in another country, and the same mechanisms are now embedded inside the financial system of the United States. The process does not begin with panic. It begins with law. When money is deposited into a bank, the legal relationship changes in a way most people never consider. A checking account is not a storage box. It is a loan. From a legal standpoint, the depositor becomes a creditor, and the bank becomes the owner of the funds. The bank records the deposit as a liability, not as property held in trust. This distinction matters only in moments of stress, but when stress arrives, it determines who bears the loss. This structure is not hidden. It is embedded in banking law and reinforced by decades of precedent. Depositors are unsecured creditors, ranked behind secured lenders and certain institutional claims. In ordinary times, this hierarchy is invisible. Withdrawals work. Transfers clear. Confidence masks the underlying mechanics. History shows that when banks fail, governments must choose how losses are absorbed. Traditionally, those losses were shifted to taxpayers through bailouts. After the global financial crisis of 2008, that approach became politically toxic. Public anger forced regulators to search for an alternative. The solution they designed did not remove risk from the system. It redistributed it. The new framework shifted responsibility inward. Instead of taxpayers rescuing banks, banks would stabilize themselves by restructuring their own liabilities. Deposits, legally classified as loans, became a source of capital in a crisis. This mechanism already exists. It has a name, and it has been used before. In early 2013, a small European banking system reached its breaking point. What followed was not chaos at first, but procedure. The events unfolded calmly, over a single weekend, under the authority of newly enacted law. When banks reopened, balances were different. Not because of fraud or theft, but because the rules allowed it. That precedent matters, because it demonstrated something crucial. In a modern financial system, loss does not require collapse. It requires authorization. The precedent was set in Cyprus in 2013, but the mechanism did not remain isolated. What happened there was observed closely by regulators around the world, not as a failure, but as a model. The Cypriot banking system was deeply insolvent, burdened by bad loans and excessive leverage. The government lacked the resources to rescue it through traditional bailouts. Instead, it chose a different path. Banks were allowed to fail without collapsing outright. Deposits above a certain threshold were partially confiscated and converted into bank equity. The process was executed quietly. Accounts were frozen over a weekend. Time, 0.5s. New laws were passed in days, not months. When depositors regained access, the losses were already absorbed. It was legal. It was final. And it worked, from the perspective of system stability. Many observers dismissed the event as a regional anomaly. Cyprus was small. Its banks were poorly managed. Its crisis seemed unique. But the lesson regulators took from it was universal. Bail-ins were faster than bailouts. They did not require legislative debate in the middle of a crisis. They avoided the political backlash of taxpayer-funded rescues. Most important, time, 0.3s. They preserved the banking system itself. In the United States, the legal foundation for this approach had already been laid. After the financial crisis of 2008, lawmakers passed a sweeping reform package intended to prevent future bailouts. Buried inside its technical language was a shift in priority. When a major bank fails, protecting the institution comes before protecting depositors. This authority is centralized. It allows regulators to take control of a failing bank, restructure its balance sheet, and convert certain liabilities into capital. Deposits above insurance limits fall directly into this category. In practical terms, cash can be replaced with ownership claims in a bank that is already collapsing. This is not a loophole. It is a designed outcome, and it exists to be used when speed matters more than consent. To understand how this mechanism operates in practice, it is necessary to look at the role of deposit insurance. In the United States, deposits are publicly framed as protected. The number most people remember is $250,000 per depositor, per bank. This figure creates a sense of certainty. It suggests a hard boundary between safety and risk. In reality, the protection is conditional. The insurance fund that backs these guarantees is finite. It represents only a small fraction of total deposits across the banking system. Under normal conditions, this limitation is irrelevant. Individual bank failures can be absorbed. Claims are paid. Confidence is preserved. The structure breaks down during systemic stress. When multiple institutions fail simultaneously, the insurance fund cannot cover all claims at once. At that point, regulators face a timing problem. Delays become unavoidable. Payments stretch from days into weeks, potentially months. Liquidity, not solvency, becomes the immediate threat. In such conditions, bail-ins offer a faster solution. They do not rely on insurance payouts. They do not require emergency funding approvals. Losses are imposed instantly on a defined group of creditors. Depositors above the insured threshold are the most accessible source of capital. Their funds are already inside the system. Their claims can be modified without negotiation. This is why the legal authority exists, not to punish depositors, but to stabilize balance sheets under extreme pressure. The goal is not fairness. It is containment. The banking system survives by reallocating losses internally, even if that survival comes at the expense of private savings. Once this framework is activated, outcomes are predetermined. The rules do not change mid-crisis. They were written long before the crisis begins. The reason this framework becomes relevant is timing. Financial crises rarely emerge from a single failure. They form when multiple pressures converge. In the period leading up to 2026, several structural stresses align inside the banking system, each reinforcing the other. Commercial real estate is the most visible pressure point. A large volume of loans was issued when interest rates were near zero and property values were inflated by easy credit. Those loans are now approaching maturity in an environment where rates are significantly higher and occupancy levels are materially lower. Many properties no longer generate enough income to refinance their debt. Defaults are not a possibility. They are a mathematical outcome. Regional banks hold a disproportionate share of this exposure. Their balance sheets are smaller. Their capital buffers are thinner. When losses accumulate, they have limited capacity to absorb them. Failure, once it begins, moves quickly. Recent history has already demonstrated how rapidly depositor confidence can evaporate when questions arise about solvency. This pressure is not isolated to commercial real estate. Residential mortgages with adjustable rates are resetting at higher levels. Consumer credit is showing rising delinquency across multiple categories. Derivative. Positions tied to interest rates and asset values amplify volatility rather than absorb it. Each of these factors weakens bank balance sheets at the same time. Regulators are not unaware of this convergence. They monitor the same data. They model the same scenarios. When multiple institutions are likely to fail within a compressed time frame, traditional resolution tools become insufficient. There is no opportunity to arrange orderly acquisitions. There is no surplus of public funds waiting to be deployed. In that environment, bail-ins move from contingency to necessity. They are not triggered by panic. They are triggered by arithmetic. When failure arrives under these conditions, the sequence is procedural rather than dramatic. Banks do not collapse publicly in the way most people imagine. They are closed quietly, often at the end of a business week. Accounts are frozen. Trading is halted. Communications are carefully worded to emphasize stability. Over the following days, regulators intervene using authorities that already exist. Balance sheets are examined. Losses are quantified. A restructuring plan is executed. This process prioritizes speed over transparency, because hesitation increases the risk of contagion. The objective is to reopen institutions as quickly as possible and prevent panic from spreading to the rest of the system. For depositors, the change becomes visible only after access is restored. Insured balances appear unchanged. Amounts above the insurance threshold are altered. In place of cash, depositors may receive equity claims or other instruments tied to the restructured bank. The numerical loss is immediate. The opportunity to object does not exist. Business accounts are especially exposed. Operating cash often exceeds insurance limits by necessity. Payroll, vendor payments, and short-term obligations depend on uninterrupted access to fund. Time, 0.5s. When those funds are partially converted or temporarily inaccessible, normal operations fail instantly. The impact spreads beyond the financial sector into employment and commerce. This is why bail-ins are designed to occur over compressed timeframes. The shorter the interval between closure and reopening, the less opportunity depositors have to react. What appears orderly on paper is, in practice, a transfer executed before most participants fully understand what has happened. The system does not require deception. It relies on speed, complexity, and prior consent embedded in account agreements. By the time awareness emerges, the process is complete. What makes this framework effective is not secrecy, but normalization. The legal basis for bail-ins has been openly documented for years. Regulatory agencies have published guidance. International bodies have issued recommendations. Resolution plans have been written and filed. None of this is hidden. It simply exists outside public attention. After the events of 2013, global regulators moved to standardize the approach. Bail-ins were no longer treated as emergency improvisations. They became the preferred method for resolving failed banks. Policy papers framed them as disciplined, rules-based alternatives to bailout. Time 0.5s, losses would be absorbed by creditors instead of taxpayers. Market discipline would be restored. Moral hazard would be reduced. In the United States, banks are required to maintain detailed resolution plans describing how they would be dismantled or stabilized in a crisis. These documents outline, step by step, how liabilities would be restructured. Deposits above insured limits are explicitly included. The process is rehearsed on paper long before it is needed in reality. This preparation serves a specific purpose. When multiple institutions face stress at the same time, regulators cannot debate options. They must execute predefined procedures. Discretion narrows. The framework dictates outcomes. What appears sudden to depositors is, from the system's perspective, long planned. This is why bail-ins should not be understood as extraordinary measures. They are the default response under systemic pressure. Once conditions cross certain thresholds, the sequence is no longer optional. The system does not ask whether depositors agree. It asks only whether the rules permit the transfer. The consequences of this structure extend beyond individual losses. When depositors realize that access to their money is conditional, trust becomes fragile. Banking systems depend on confidence more than capital. Once that confidence fractures, even solvent institutions can be pulled into crisis through rapid withdrawals and cascading fear. This dynamic accelerates failure rather than preventing it. Depositors who observe losses at one institution rush to protect themselves at others. Liquidity drains across the system. Banks that would have survived under stable conditions become vulnerable under collective panic. The mechanism designed to contain risk begins to propagate it. History shows how quickly this shift can occur. Modern banking operates at digital speed. Withdrawals happen in seconds, not days. When confidence breaks, time compresses. Decisions that once unfolded over months now unfold over hours. In such an environment, regulators prioritize control over reassurance. This is where restrictions emerge. Transfers may be limited, withdrawals capped, accounts temporarily frozen. These measures are not introduced as punishments, but as stabilizers. Their purpose is to slow the system long enough for resolution plans to be executed. For depositor, time 0.3s. The experience is the same. Access disappears precisely when it is needed most. The result is a paradox. The more integrated and efficient the financial system becomes, the less tolerant it is of shock. Stability requires intervention that overrides individual claims. The system survives by constraining its participants. Understanding this dynamic changes the nature of risk. The danger is no longer a single bank failure. It is the collective response to the realization that deposits are conditional by design. What ultimately determines outcomes in this environment is preparation, not prediction. Bail-ins do not announce themselves. They emerge from conditions that build quietly over time. By the moment they are visible to the public, the mechanisms are already in motion. The legal authority has been established. The procedures have been rehearsed. The sequence unfolds according to plan. This is why historical patterns matter. In every major financial crisis, losses were imposed where resistance was lowest and speed was highest. Depositors, positioned inside the system and bound by contract, occupy that role. Their funds are liquid, accessible, and legally transformable. From the system's perspective, they are the most efficient source of stabilization. The critical distinction is not wealth, sophistication, or intent. It is exposure. Funds that remain inside the banking system are subject to its rules. Funds that sit outside it operate under different constraints. This is not a moral judgment. It is a structural reality. When stress converges across multiple sectors, choices narrow. Regulators act to preserve continuity, not to preserve individual outcomes. Stability is measured at the system level, not the personal one. Those who understood this before the crisis adjusted quietly. Those who did not discovered the rules only after they were enforced. History does not repeat because people fail to notice signals. It repeats because systems apply the same solutions when faced with the same pressures. Bail-ins are not an exception to that pattern. They are its modern expression. At the end of every systemic crisis, the same question emerges, framed differently each time. Why did so many people fail to act when the information was available? The answer is rarely ignorance. It is familiarity. Banking systems function smoothly for long periods, creating the impression that access equals ownership and stability equals safety. The framework described here does not depend on deception. It depends on normalcy. Depositors continue daily transactions. Salaries are paid. Bills clear. The underlying rules remain dormant until pressure activates them. By the time those rules are enforced, the opportunity to respond has passed. This is what makes bail-ins effective from a regulatory perspective and devastating from a personal one. They operate inside the legal boundaries of the system, using mechanisms that were accepted long before they were understood. There is no single moment of failure, only a transition from assumption to reality. When historians look back on financial collapses, they rarely focus on the technical details. They focus on behavior, on who recognized structural risk early and who trusted continuity until it broke. The difference is not intelligence. It is attention. The next crisis will not introduce new tools. It will rely on the ones already in place. The question is not whether the framework exists. It is whether individuals recognize how it functions before it is applied.